everyone. Thank you very much for joining us today. My name is Patrick Ray. I'm one of the retirement advisors here with the Retirement Group, and we appreciate your attention this afternoon. As we wind down 2022, we have some great material to cover with you today about what we talk to our folks about related to some investment strategies and some current information related to the economic conditions and how to apply and employ that strategy related to your life savings. So before we get started and cover today's material, I want to cover a couple of things with you. First and foremost, we have no affiliation with ExxonMobil, nor do we have any affiliation with Voya. As it turns out, our experience over the last 30 years of being with the company is directly related to people who are in situations similar to yours and helping them transition into a successful retirement. And one of the many tools that we have in an effort to do this is the webinar platform that we're here today with you on, and giving you the updated material that will help you make some of these transitions and answer some questions and kind of give you some feedback on what we talk to our people about on a regular basis. But we also have some other material that you might find useful. You'll find links into the chat to get access to our ebooks library, which has a bunch of short to read topics that we get asked very common questions on a regular basis. So we encourage you to check those out at your own leisure, as well as some of the recordings we've done in the past with the webinars on a myriad of topics that we also find useful in certain situations. So we encourage you to check those out at your own leisure. And lastly, the thing you might find the most value of is spending some time with us to develop a cash flow analysis. And this is a complimentary service that we offer to the people who are open and interested in doing this, which is spending a few minutes with us to better help us understand what some of your goals and objectives are. And it's an effective stress test of your overall retirement goals. And so you can find out if you're on track to meet those objectives and be comfortable with the planning process and steps you're taking to meet your long-term priorities for retirement. And so we'll give you access to get in touch with us in the event that you're open to that at the end of the workshop today. And also, if you have any questions about anything that we're covering or something that you want to know more about specifically, feel free to drop those questions into the question and answer box, and we'll do our very best to get to those at the end of the workshop. So without further ado, I will bring on today's speaker and my partner, Tyson, to talk about today's material. Tyson.
Thank you, Patrick. Thank you, folks, for attending our webinar series this afternoon. My name is Tyson Mavar, one of the ExxonMobil focused retirement advisors for the Retirement Group here in Texas. And in today's workshop, we're going to be talking a little bit about the economy and what's been happening in this environment for retirees. It's been a tumultuous year in 2022 for stocks, for the economy. We've had the Federal Reserve increasing interest rates at a historically quick rate in an effort to fight long-term inflation. We have the broad stock market, at least as measured by the S&P 500, down more than 15% in less than a year. So what are we at the Retirement Group doing and recommending our clients do to help people protect as well as grow their assets so that they don't run out of money in retirement or outlive their assets? Those of you who aren't as familiar with our company, Retirement Group is an independent financial consulting company that specializes in working with corporate employees. ExxonMobil happens to be one of the companies that myself and Patrick and several of our other advisors of the company specialize in helping through this transitional process. But we also manage retirement assets for the employees that choose to work with us after they leave ExxonMobil. Typically, it's at least the 401k plan, sometimes a portion of the pension, or maybe all of the pension, assuming that they decide to take that pension as a lump sum. And our hope is to help them meet all of their objectives. And everybody's objectives are a little bit different, so we want to get to know our folks. And one of the best ways we can do that is by running a cash flow analysis to understand how sustainable is your plan right now, and what are some things that we can consider doing to improve the sustainability of that plan. In other words, reduce the probability of you running out of money in retirement, whether it's saving on taxes, avoiding penalties, making sure you don't leave any money on the table at ExxonMobil, making sure you're maximizing the benefits when you leave the company. We identify these things through running this cash flow analysis, and then we continue to update that analysis to account for changes and the moving parts, things that we couldn't predict throughout our retirement. So take us up on that if you haven't done so already. And another way to get good information related to the ExxonMobil retirement process through our LinkedIn page. If you're not following us on LinkedIn yet, I highly recommend you do so. Now, today we're going to talk a little bit about where we are in today's economy. We saw some tremendous, unprecedented government spending in the last several years, in part to do with the COVID-19 pandemic. This is probably going to result in higher tax rates in the future, and there's a whole seminar that we do on tax strategies for retirement accounts to protect yourself from the uncertainty of future taxes on your retirement accounts. But in the short run, what we've seen as a result of monetary fiscal stimulus, monetary government stimulus with this, which is what we saw with the reduction of interest rates over the last couple of years, we saw unprecedented levels of inflation that we haven't seen in over 40 years. And so that's what we've been dealing with here in 2022. And what we have some investment recommendations related to this higher interest rate environment we're in, as well as the likelihood of continued higher than average inflation on our cost of living in retirement. And then what do we actually do to this? So today's opportunities, what investments might you want to consider focusing on as you either enter into retirement or somebody who's newly in retirement? How do we make this money last the rest of our life in light of the circumstances that we're in today? Before we get into that, though, I do want to focus in on today's interest rates as they pertain to the ExxonMobil pension lump sum. So you can see this table here is reflective of the most recently available interest rates, September and August, which, as many of you know, will predict the first quarter lump sum interest rates and lump sum payouts. Now, this is for non-grandfathered employees, which is probably close to 99% of the ExxonMobil community today. Some folks are still grandfathered if you are 65 with at least 25 years of service by the end of this year. If you don't meet one of those age or service benchmarks, you'll fall into these corporate bond interest rates, which you can see are first segment, second segment, third segment interest rates. These are related to short, intermediate, and long-term corporate bonds, respectively. And when these interest rates go up, everybody's lump sum goes down. And rates have gone up quicker this year than I've seen them go up in my entire career with the retirement group, which started in 2011. So it's been more than 11 years. We haven't even seen interest rates go up this quickly, even come close to going up this quickly. So let's talk about what this actually means to your pension. So you can see Q1 2023 blended interest rates. I want everybody to focus on the second segment rate, as that is the rate that impacts your pension more than any of these rates, carries the most weight in the calculation. That interest rate is 4.94, which, if you do the math, that's the average of 5.26 and 4.62, the August and September interest rates, which, as it turns out, are the fourth and fifth month prior to the first quarter. That's how they calculate this pension, is by looking 4 and 5 months prior to the beginning of the first quarter, January 1st, and taking the average of those rates. They get these blended rates. Now, one thing to remember is a rule of thumb, although it varies from person to person, is that every 1% increase in these interest rates results in about a 10% reduction in your lump sum payout. Could be hundreds of thousands of dollars. We've seen this in many of our clients' cases, and many of our clients decided to retire this year as a result of these rising interest rates. So if you are still working at the company, you've probably already seen your lump sums deteriorate pretty quickly this year. That doesn't mean it's too late to retire. For some of you, you want to pay very close attention to this. If you are either close to retirement yourself or considering leaving ExxonMobil and going to work somewhere else in an effort to, at the very least, protect your lump sum payout and your retirement plan, now is the time to be considering this and running your numbers to see what alternatives might produce a better retirement plan for you and your family. Now, I will add that the October rates have been published, and although the October does not play a role in any of the quarter's lump sum calculations, it does give us an indication where interest rates might be going for the second quarter payouts. The second segment rate for October was 57 basis points, more than 0.5% higher than the September interest rates, meaning that if rates stay flat through November and December, we're likely to see close to another 0.5% increase in the second quarter, which means folks might want to consider leaving by February 28th and commencing your benefit March 1st if you're a non-grandfathered employee, to lock in the first quarter interest rates. If you're a grandfather, they let you work all the way up to the end of the quarter and still maintain that first quarter interest rate. And we do not know yet where the grandfathered rates will be going for the second quarter, but Treasury bond interest rates have increased as well. Talk to us if you're not familiar with or comfortable with how these issues work. And we're delighted to help you run some pension projections. Make sure that you're not leaving any money on the table based on the timing of not only your retirement from the company, but also the timing of your pension election. And those might be two different dates, as it turns out. So let's talk a little bit about where we are in the markets and some potential opportunities, things to consider as far as your retirement plan goes. Now, our company, the Retirement Group, is a value investment firm. We believe in buying great companies at a reasonable or great price when we can find them. Not always easy to do. It does take some work, more work than somebody who has used their 401k most of their career to do what we call index investing. Many of you are probably familiar with your 401k options, the equity units, which is almost synonymous with the S&P 500 or large cap stocks. And you have a variety of other investment options that are investing in the indices, S&P 500, Russell 2000, the international EFA index, the aggregate bond index. You're not being selective with what you're investing in. You're just broadly investing your money across broad market-based indices. So we would prefer to, in an effort to protect capital better, be very selective with what investments we choose to add to a retirement portfolio. And here's our philosophy in doing so. We like companies that have good fundamentals, fundamentals such as solid price to book ratio, which is the price of a company's stock relative to its book value of assets, all right, assets minus liabilities. We have price to earnings ratio, which is the price of a company's stock relative to the profits that the company is generating, and a whole host of different metrics that we look at when we're trying to evaluate, is this company, first of all, a good company to be investing in? And as importantly, is this company at a reasonable price? Same way we buy groceries, same way we buy Christmas presents. Many of you are probably doing a little bit of shopping coming up this month. We want to buy our investments the exact same way, be cognizant both of the value of what we're purchasing, but also the price of what we're purchasing. Our primary goal in a retirement portfolio is to avoid what we call permanent loss of capital. And we want to be sure to differentiate between permanent loss of capital and temporary loss of capital. Temporary loss of capital is, let's say you buy ExxonMobil stock at 80 and it goes down to 75. If that stock, if ExxonMobil in this case is, in your opinion, worth more than $80 a share, that's probably why you purchased it. But that would be considered a temporary loss of capital. As long as you don't need that money, you're okay with that being illiquid in the short run, that's okay. If we're going to expect some volatility when we're investing in stocks. Permanent loss of capital is a good example, might be buying tech stocks, buying the NASDAQ index in the late 90s, very popular at the time, but what took close to 20 years just to break even for those that bought at the top. We might consider that a permanent loss of capital if you needed that money during that 20-year period that it took you to make your money back, to be able to liquidate those stocks, to pay your bills in retirement, for instance. So these are one of the reasons we focus on value investments, is looking at a company that we are comfortable holding for the long run. We're not trying to time the market. This is one of the biggest detriments to a retirement investment strategies, folks that are allowing their emotions to drive their decision making, and in doing so often sell at the worst time possible, but also buy at the worst time possible. Are willing to buy something expensive because it might be popular, but try to avoid something that might not be popular, even though it's at a great price, just because it's uncomfortable to own. And this is what value investing is all about. One of the reasons not everybody can be a value investor, because it does take patience and it does take work. It takes a little bit of research on our part. We want to buy companies with a margin of safety, which means if we can buy a good company at a reasonable price, or even better when it's on sale, it gives us some room for error. In other words, there's going to be things that we can't predict, whether, let's use an oil company, ExxonMobil. We can't predict the regulatory environment that is given to us by politicians. We can't predict something that might happen in the Gulf, such as an oil spill, knock on wood. There's things that we won't be able to predict, but if we buy a company or a stock on sale, it gives us some room for error, what we call a margin of safety that allows us to account for the unpredictable nature of investing. And ultimately, we want to reduce our risk of running out of money and specifically permanent loss of capital. This is the reason that we are attracted to value stocks or good companies that we can buy at a reasonable price. Now I'm going to blow this up a little bit. Compare value stocks to growth stocks. If you go back the last 100 years, which we haven't done so on this chart, but over the last 100 years, you see value stocks go in and out of favor compared to their counterparts, growth stocks, meaning that there's times that growth stocks outperform value stocks and vice versa. It's almost like the changing tides in the ocean, where you have ebbs and flows in terms of the performance of the style of different stocks. Historically, value stocks have outperformed growth stocks in the long run, but there's going to be times where growth stocks outperform value stocks. And this recent 10-year period has been one of those times. You can see going back to, if you look at the blue line, which is growth stocks, you can see going back to 2010, we started to see dispersion of performance. And especially after a lot of the government stimulus and policy changes as a result of the pandemic, we saw growth stocks get even more expensive relative to their value counterparts. So while there were a couple periods here where you would have made a lot more money investing in growth stocks, we wanted to show this as communicating the fact that we are in an environment right now that's very unique, where the difference between valuations on growth stocks and value stocks is as big as it's been in a very, very long time, several decades, probably even worse than it was in the late 90s. Our thesis here is that value stocks are as cheap as they've ever been when compared to the overall market as a whole, and especially when compared to growth stocks, or expensive stocks is another way to think of growth stocks. Now let's look at another graph here. Here's looking back a little bit deeper into the past, going back to the mid 80s. Here's that title chart that I mentioned earlier. You can see value stocks outperforming growth stocks in the green sections below the x-axis, and growth outperforming value above the x-axis in gray. You see, we've been in a very long period of growth outperformance on value, and our thesis here is there's never been a better time to be investing in value stocks. It's always a good time to buy value stocks, but right now, especially with the uncertainty in the economy, with what's happening both in fiscal and monetary policy, we want to be prepared, especially in a retirement portfolio, and really in any portfolio, but most importantly in retirement, so that we're not suffering from permanent loss of capital on a retirement plan. Here's a great quote from Charlie Bobrinskoy. If you go back to 1926, value has outpaced growth in every 10-year period, except for the last 10-year period. So just more evidence of our thesis here that we're in a great time to be overweighting value stocks in our retirement portfolio. Remember, you can't have, at least most people can't afford to have a retirement portfolio that's completely made up of stocks. And that's why you might consider working with an advisory firm or retirement consulting firm to help you with asset allocation, having things like bonds, real estate, cash, maybe annuities in your portfolio to diversify against stocks. But most people also don't have enough money to not have any stocks in their portfolio, with the very minimum objective being to outpace inflation so we don't run out of money too quickly. And here's what we recommend for the stock portion of our client's portfolio. Another way to think about this is just looking at buying a stock as if we're buying a business. And we've simplified this to an example of buying a flower delivery business. So think about this business. The cost to buy the business, $200,000. The book value of the company, which is the assets minus liabilities, because this company has no debt, it's going to be purely the value of its assets, which is 5 delivery trucks worth $160,000, inventory valued at $10,000. So the book value, $170,000. Company could sell all of its assets in a fire sale, as we call it, and they don't have any debt, so they'd get $170,000. So basically, if you could buy that company for less than $170,000, that would be a fantastic bargain. You could immediately have what we call an arbitrage opportunity or a risk-free profit. Not very common, especially when it comes to publicly traded stocks. But think about that as there has been companies, by the way, that have had that aspect to the company and some fundamental incentive to buy the company. They're just very rare. Now, this company is churning out $30,000 of net income or profits to the owners. And as an owner, we have the option to take those profits to ourselves, spend them, or invest them somewhere else. We can keep them within the company and reinvest them in maybe buying more inventory, buying another truck, maybe doing some marketing. We have options with that money. For ExxonMobil or a large publicly traded company, typically they're paying that out as a dividend. But oftentimes we see companies that find their own stock on sale will repurchase shares of their own stock. That is a great indication that the company's board of directors feel the company is on sale and something we might want to be looking at. We saw Berkshire Hathaway, one of our favorite holdings, purchasing a lot of their own stock this year because Warren Buffett and their team of managers, felt that their stock was on sale or the best option for them to use their retained earnings, the best investment for their money. So think of buying a stock not like a line on a chart or a dot on a screen. Think of buying a stock as buying a piece of business, because that's exactly what we're doing. Now, unfortunately, we had some very high government spending. Many will argue whether or not we overshot it through the pandemic. But what most people don't argue is that we're likely going to see higher taxes in the future as a result of this excessive government spending in the last several years. So let's talk about some of the issues as well as the opportunities with this. We do want to take advantage when we can of price volatilities, take advantage in two ways: selling some of our winners in a retirement portfolio and maybe socking them away in safer areas. That's what rebalancing helps us do in retirement strategy, which is selling stocks and buying bonds after stocks have outperformed bonds, and vice versa. When stocks have gone down, we buy stocks by selling bonds or cash or some of our other non-stock investments. And over time, that ends up creating a better long-term performance within that retirement portfolio. I want to take advantage of the irrationality in the market. Fear is one of the most common emotions that we have when we make decisions, especially when we make decisions with our money. Greed happens to be another one, though. And if we can take advantage of other people's fear and greed, oftentimes we can find great opportunities in the market, but we also can sell our winners and not hold on to them too long because they're very popular, because the rest of the market has gotten very greedy. Value investing helps us get back to planet Earth in terms of what a company is actually worth. We try not to get caught up in herd behavior. It's almost impossible because we're all human, and we oftentimes make decisions on comfort and emotions. And sometimes going with the herd or being a part of the majority helps us be comfortable in decision making. But historically, what we found out and statistically is that that's actually the opposite of how people would be best suited to make money, because the herd is often wrong and usually buying investments when they're too expensive and selling them at the worst times after they've become on sale and might be a good purchase. Try to be patient, try not to be greedy, be fearful when others are greedy, as Warren Buffett says, and be greedy when others are fearful. And at least here at the retirement group, we like managers who not only have the ability to hold cash when it's warranted, meaning that they're not forced by their prospectus to be fully invested in stocks, even if they feel very uncomfortable about that position, but also have managers that have a good track record of going to cash or holding cash when times warrant, when there's just not a lot of bargains available, which is different than market timing, by not being fully invested just because we don't have enough companies that we would prefer to hold. Now, as it turns out, oftentimes the best time to buy an investment is when we're least comfortable doing so, because that's when we get the best deal. And to potentially reduce our risk in our retirement portfolio, we need to find investments that are on sale. So even if the market, the broad market as a whole, might be expensive, we argued that very aggressively last year, and we still argue that there's a lot of companies that are way overpriced right now, even though many of them have gotten hit this year in 2022. That doesn't mean we shouldn't be invested at all. And there's almost always a decent bargain available, as long as we don't need that money in the short run. That's where becomes critical for asset allocation to understand your short-term income needs. For those needs, don't invest in stocks, but it's your long-term income needs in a retirement portfolio, which many of you may have a 30-year time horizon in retirement. It's okay to invest in stocks for the money that we don't need for a while, but we certainly don't want to have all our money in stocks given the cash flow need that our retirement portfolio is required to produce. And accept comfort for these long-term investments. We need to accept discomfort to be able to find good companies, good investments that are on sale, whether it's in real estate, whether it's in bonds, whether it's in equities or stocks. We want to evaluate all of these things before we're investing our precious retirement nest egg into various investments, rather than just buying everything, which some people might recommend you do just because it's the cheapest way to go by indexing. Not always the best, though, in our opinion. And as it turns out, history has shown that the best time to retire is when we're least comfortable in doing so, because that's when stocks are on sale. History has also shown us the best time to retire is when interest rates are low, even though our retirement portfolio is not able to produce as much income, at least on the bond or fixed income side, especially when you have a pension whose lump sum is dictated by interest rates. It's a great time to be taking a pension. Although interest rates have gone up very quickly this year, historically, they are still quite low if you look back at the last 50 years. So there may be some still good opportunities to take a lump sum, although remember, the lump sum is not appropriate for everybody, and the annuity options have to be considered. And you have a pretty flexible plan, given that you can take a partial lump sum and partial annuity, which could make some sense for you. And just trying to manage the emotions when making investment decisions, when making decisions about our retirement, about who to take advice from, the timing of our retirement, which way to go on our benefits, how to spend money, how to build a plan. All of these things, we want to try to be as conservative as possible, but it helps to have lots of different sounding boards for our ideas. And that's what we found we could be helpful to folks as advisors. It's probably also good to have sounding boards within your family or trusted individuals in your sphere. But having lots of information is helpful because you ultimately have to make these decisions. And the more information you're armed with, the better chances you are of making a decision that you're not going to regret in the future when it comes to your money. Now, unfortunately, statistics say that 74% of Americans over the age of 50 do not have a written plan for their retirement, which in our opinion is absolutely unacceptable. There's no reason not to spend some time on this, given the importance of your retirement plan. Think of your retirement as the longest vacation of your life. Statistically, people spend more time planning for their vacations than they do for their retirement. In part, we believe that's because it's not the most attractive thing to think about, retirement. It's, we're going through some changes. We're leaving our comfort zone of work, our coworkers, what we've known, where we identify with in our jobs. So not everybody, unfortunately, is comfortable spending a lot of time thinking about retirement, but there's not a more important investment of your time as you approach retirement, in our opinion. If you're willing to spend some time with us, we're willing to spend some time with you on a complementary basis to build this retirement plan, which we call a cash flow analysis. Let us know if you've never got one. Strongly encourage you to spend 15 to 30 minutes with us to get one done. If you have, and it's been over a year since we've updated yours, let us know. We're happy to do this on a complimentary basis. If for no other reason, to improve our reputation within the ExxonMobil community so that we can continue to grow our business over time. And if you're looking for an advisor in retirement, we're delighted to talk about how our company works, the cost of our services, and the value that we bring to the table, and why you might consider working with our company. If you'd like to schedule a call or just have some specific questions, you can email us at info@theretirementgroup.com. You can call us at 800-900-5867. You can also schedule a meeting through this QR code at the bottom here. Take a picture of it with your smartphone, and you can get onto mine, Patrick's, or any one of our ExxonMobil folks advisors' calendars. And then again, here's that LinkedIn page QR code to keep up to speed with different changes going on with the benefits plans and new retirement planning strategies. Highly encourage you follow us on LinkedIn as well. Patrick, that's all I had for today. If we do have any questions on today's call, or if you have any last minute housekeeping issues to bring up, I'm going to pass it back to you.
Yeah, we've got a couple of questions, and I'll take this first one because this is something that I just went through with one of our ExxonMobil folks. And the question is, if we have a recession, does it make sense to take my money out of the 401k and just hold the cash? So many of you may be surprised at the number of calls that we get with market related activity and what it means to their retirement plans. And what I mean by that specifically is an action or what they feel like is an action that needs to take place because of a recent market movement. So there's been a number of occasions over the years where we've had either steady or sharp declines in the market, and it affects your 401k. And believe me, no one wants to look into their 401k at Voya and see it down by 10 or 15 or 20% or something, especially in a given short window of time. And so what I would say to this person is, if you feel the need to react to something that's occurred in the marketplace and it's gotten you to the point where you're uncomfortable with the positions that you hold and basically what values you have dropped in a short-term time window, I would encourage you to spend some time with us so we can do a risk assessment to ensure that your allocations are appropriate for what you're comfortable with. Most of the time, what we see is that investments are typically invested too aggressively because the sharp decline happens in a short window of time, and it makes somebody uncomfortable, only to find out that they had too much money in stock, for example, for their risk tolerance or for their objectives or for their old long-term goals. And so it's very tough to make a reactionary approach in your 401k subject to something that's transitioned or already happened in the stock market. And so what we want to make sure that if this happens, or if you have a feeling or a concern about this, that we address this to the extent where we take a step back and do an analysis of your overall tolerance for risk and ensure that your allocations are consistent with that. And that would be my first recommendation and our first steps to help someone in this position if you feel the need to make a change to your 401k because the stock market went down in a given week or a month or something. Okay, so here's a question for you, Tyson. Do Roth conversions make sense when my portfolio is down?
Possibly. This is the best time in my experience to be considering a Roth conversion anyway, with the end of the year, because toward the end of the year, we have an idea of what our income is going to be this year, and therefore how much room we have to the next tax bracket to consider a Roth conversion, which for those of you who aren't familiar, a Roth conversion is taking pre-tax money that might be in your 401k, in a traditional IRA, moving it to a Roth IRA, which, as it turns out, there is no limit of how much you can do in any given year. And it becomes more difficult to do these once you turn 72 and have to take a certain amount out of your IRA through what they call required minimum distributions. So oftentimes when somebody, even if somebody who's close to the end of their career, we have to look at what your income is and also what we project it to be in the future to see if now might be a good opportunity to do so. But to this person's point, the best time, if we could time this perfectly, the best time to do a Roth conversion is at the bottom of the market, or when a stock that we're converting is as cheap as it possibly is. Because for two reasons. A, because the value that's being taxed when we move that asset, let's say we take ExxonMobil stock when it was $40 a share, for instance, I think it was only a year and a half ago. We move it over to our Roth IRA. It only cost us income of $40 per share to do that. But then the other benefit, and that's compared to, let's say, $107 a share. The other benefit, though, is when, assuming that stock does recover and grow again, all that recovery is tax-free growth. So the stock goes from 40 to 107. That's all tax-free earnings. Whereas in an IRA, all that money would be taxed as ordinary income. And even in a brokerage account, you'd have capital gains on that. So great question. Now's a great time to be considering this. Call us and schedule a 10 to 15 minute call to talk about your specific situation. We'll tell you what we think.
Yeah, so this is kind of tied to the question I took, Tyson, but I'll let you elaborate on this since you'll have some different feedback for sure. And the question is, my ExxonMobil 401k is getting hit. Obviously, it's declining in value, certainly in this particular tax year. And the question is, what can I do to insulate my portfolio, and should I hold and weather the storm?
Yeah, good question. If you are still working, you don't have a lot of flexibility because you're locked into that 401k plan for the vast majority of your money. In some instances, they will allow you to do what's called an in-service rollover, which means you take a portion of your 401k even while you're still working and roll it over to a traditional IRA or a Roth IRA. No taxes if it's done correctly. The main benefit of this is that you have vastly more investment options in the Roth and traditional IRAs than you do in the 401k. When you retire, you can move your whole plan anyway. So it just becomes a little bit more difficult when you're still working, a little less flexible at least. Now, there are some decent investment options in the plan. They're extremely inexpensive is the best part about the plan, but they're just very limited on what you can invest in. Now, you can invest in some index funds, like I mentioned on today's webinar, equity units, extended market units, international equity units, the bond units, common assets, and ExxonMobil stock, of course. If you are somebody that had ExxonMobil stock in your plan this year, you probably did better than the average retiree or pre-retiree just because it's had a banner year. The whole sector, the whole energy sector has had a great year, which might be a reason to consider taking some of those gains off the table. But if you're somebody who suffered some big losses, like it sounds like you may have, we need to understand more about your time horizon to retirement, your overall comfort and capacity for risk, as well as your cash flow needs before we can start making recommendations. So again, unfortunately, I can't tell you without knowing more about you what I'd recommend. Call us, we'll get to know you a little bit and let you know what we think.
Okay. Can you talk a little bit about the value investments doing better in an inflationary environment than growth investments?
Sure. Yeah. So here we are in an inflationary environment that we haven't seen in many decades. What happens is, and I'll give you an example. Let's try to predict what the value of a company is going to be in the future. There's a lot of ways that we do that. We have to look at the current earnings. We also have to make an assessment on what the future earnings are going to be. There's a variety of ways to do that. But some companies' value or the price of their stock, what somebody's willing to pay in the market, is determined based on that company's current earnings. That's the reason it's valuable. There's some companies, though, that have a high stock price that don't even have any current earnings, that are all based on future earnings. And that's more so growth stocks, whereas value stocks are typically companies that have current earnings, or at least a good track record of producing earnings. Now, the more guesswork or the farther out those earnings are into the future, the more they are affected by interest rates. And here's why. If it's going to take me 10 years to churn out a profit in my company, the value of money is becoming less and less over time. So those profits are less and less valuable to me over time. However, in a low interest rate environment, those profits aren't discounted at as high of a rate, meaning that it's not as detrimental that those earnings are in the future versus the present. Now, when interest rates start to go up, now it becomes a bigger detriment because money is more valuable. I could take that money and rather than waiting 10 years to turn a profit, I could throw it in corporate bonds and maybe make 6%. So that the time value, there's a time value of money aspect to that. There's also an aspect of how much debt does that company have? And when debt becomes more expensive, as it does in a rising interest rate environment, those future profits become a little bit more painful about being in the future rather than in the present. So we're looking at the discounted value of future cash flows, bringing them back to a present value. When we use a higher discount rate, those future profits aren't as valuable. And that's why growth stocks get hit. They get hurt a lot more in a rising interest rate environment than do value stocks. And as we know, inflation and interest rates tend to be correlated. When inflation's going up, we see interest rates typically going up to fight that, and vice versa. So that's what we've seen, at least historically. There's no guarantee of that, but we also have really seen that here in 2022. And from at least our company's opinion, the retirement group, what we expect to continue to see in the not so distant future, the next couple of years for retirees. One of the reasons we're overweighting value stocks.
Okay, last question for the afternoon. And the question is, with interest rates going up, how does that affect the stocks in the ExxonMobil 401k? Is value better with rising rates?
Yeah, fair question. Again, you're limited on what you could purchase in the plan. You have index funds. Let's talk about the S&P 500 is probably the best example, and not just for ExxonMobil employees, but specifically to this plan, because it's one of the few investment options you have. In a rising interest rate environment, we talked about why that is more detrimental to growth stocks than it is value stocks. And as it turns out right now, the indices are heavily weighted in growth stocks. Growth stocks make up a bigger portion of the index than value stocks. One of the reasons for that is because many indices, like the S&P 500 being one example, are what they call capitalization weighted. What that means is that if we take the S&P 500, they don't equally invest in each of those 500 companies. They invest more money in the big companies and less money in the small companies. And they determine that based on what's called market capitalization, which is the total shares outstanding of a company multiplied by its stock price. So when an expensive company gets more expensive, when its stock price goes up, turns out that the S&P 500 invests more money in that company. As you probably know, a value investor would actually, in many cases, do the opposite if that's really all that changes about a company, other than the this is one of the reasons a lot of people will roll over their 401k after they leave the company, although you do not have to do so. There's no time frame you have to do that within. Not very much flexibility, but we're happy to do a 401k asset allocation review with you if you're somebody who still is stuck in that Voya 401k plan.
Okay, well, that wraps it up for us today. We certainly appreciate your attention this afternoon. We hope that you found some value in spending some time with us for sure. And as we wrap up the rest of the year, we hope you have a wonderful, safe, and happy holiday. And everyone take care. We'll see you next time.
Thank you, folks.